studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Throughout this chapter, we've explored two primary approaches to reporting investment income when a corporation has a non-calendar year end. Option 1 focused on matching investment income to the corporation's fiscal year. Option 2 focused on using the T3 and T5 slips directly as they are received. Both approaches are widely used. Both approaches can be reasonable, and both approaches solve important problems. However, as we've seen, neither approach is perfect. Let's begin with option 1. The biggest strength of option 1 is accuracy. By estimating missing investment income and allocating amounts to the correct fiscal period, the corporation achieves better matching between income earned and income reported. This often produces more accurate year-end reporting. It aligns more closely with the economic activity that occurred during the fiscal year. For many accountants, that improved matching is highly desirable. But accuracy comes with a cost. Option 1 requires estimates. Those estimates must be documented. Future adjustments may be required, and reconciliation work continues year after year. The process can become time-consuming, especially when investment portfolios are large or complex. Now let's look at option 2. Option 2 takes a much simpler approach. Instead of estimating missing information, the accountant waits for the T3 and T5 slips and records the amounts directly when the slips arrive. This reduces administrative work. It simplifies bookkeeping, and it avoids many of the challenges associated with estimation. For some corporations, that simplicity is extremely attractive. But simplicity also comes with a trade-off. Timing differences remain. Income may be reported in a different year than the one in which it was economically earned. And as a result, the matching between income and the corporation's fiscal year may not be as precise. This brings us to the scale shown in the center of the slide. Option 1 leans toward accuracy. Option 2 leans toward simplicity. Each side offers meaningful advantages, and each side introduces certain limitations. This is where experienced accountants often begin asking a different question. Instead of asking which method is better, they ask, can we combine the strengths of both? Can we preserve much of the accuracy provided by option 1 while retaining some of the practicality and simplicity offered by option 2? That question leads directly to the idea of a hybrid approach. The hybrid approach recognizes that accounting is rarely about choosing extremes. In many situations, the best solution lies somewhere in the middle. Rather than relying entirely on estimates or relying entirely on T-slips, the accountant uses the best available information, applies reasonable judgment, and reconciles differences when additional information becomes available. This allows the reporting process to benefit from both accuracy and practicality. The memory box on the slide summarizes the idea perfectly. Option 1 represents accuracy. Option 2 represents simplicity. And the goal of the hybrid approach is to bring those strengths together. The key takeaway from this slide is simple. Neither option 1 nor option 2 is perfect on its own. Each solves certain problems while creating others. The hybrid approach exists because many accountants believe the best reporting solution combines the strengths of both methods, rather than relying exclusively on either one. And that is exactly what we'll explore in the next slide. Now that we've seen why a hybrid approach exists, let's look at how the methodology actually works in practice. The hybrid approach is designed to combine the strengths of both reporting methods we've discussed throughout this chapter. It recognizes that some information is available today, some information is missing today, and additional information will arrive in the future. Rather than ignoring missing information or waiting indefinitely for perfect information, A hybrid approach creates a structured process for dealing with both. Let's walk through the 5 steps shown on the slide. The process begins with gathering all available information. At year-end, the accountant collects everything that is currently available. This may include investment statements, broker reports, partial T-slips, transaction summaries, prior year information, and historical trends. The objective is simple. Start with the best evidence currently available. Next comes the estimation step. If certain information is still missing, the accountant determines whether a reasonable estimate can be made. Notice the word reasonable. The hybrid approach does not encourage guessing. Estimates should be supported by evidence, historical patterns, and professional judgment. Just as importantly, the assumptions should be documented. Anyone reviewing the file later should be able to understand how the estimate was developed. The third step is one of the most important. Track the differences. Whenever estimates are used, the accountant creates a mechanism to monitor those estimates. This may involve reconciliation schedules, clearing accounts, working papers, or other supporting documentation. The goal is to ensure that estimated amounts can easily be compared with actual amounts when additional information becomes available. This is where many reporting problems are avoided. Good accountants don't just estimate. They create a system that allows those estimates to be verified later. The fourth step occurs when the final information arrives. Eventually, the T3 and T5 slips are received. At this point, the uncertainty begins to disappear. The accountant now has access to the actual investment income information and can compare it against the earlier estimates. And that leads directly to the 5th step: reconcile and adjust. The estimated amounts are compared with the actual amounts shown on the T-slips. Any differences are identified. The records are adjusted if necessary. The estimates are corrected, and the changes are documented. This is why the scale shown on the slide is so important. The objective is not to make perfect estimates. The objective is to make reasonable estimates and then verify them when better information becomes available. The experienced accountant shown on the slide summarizes the philosophy perfectly. I estimate carefully today and verify later. That single sentence captures the essence of the hybrid approach. And notice the benefits that result. Better matching between investment income and the fiscal year. Fewer surprises when final information arrives. More accurate reporting. Stronger documentation. And a workflow that remains practical and manageable. The memory box provides a simple summary of the entire process: estimate, track, verify, adjust. Those 4 words describe the cycle that drives the hybrid methodology. Perhaps the most important lesson is the quote at the bottom of the slide. Good estimates are temporary. Good reconciliations make them reliable. In other words, the strength of the hybrid approach is not that estimates are always perfect. The strength is that the estimates are supported, monitored, and eventually verified against actual information. The key takeaway from this slide is simple. The hybrid approach uses the best information available today, applies reasonable estimates when necessary, tracks differences carefully, and reconciles those differences when final information becomes available. By combining estimation with reconciliation, the accountant achieves a reporting process that is both practical and increasingly accurate over time. We've reached the final slide of this topic, and this is a good opportunity to step back and look at the complete reporting framework we've built throughout the chapter. At the beginning of this course, the challenge seemed relatively simple. A corporation had a non-calendar year end, while investment income information was often reported on a calendar year basis through T3 and T5 slips. But as we've seen, that difference in timing creates a series of practical reporting challenges. Investment income continues to flow throughout the year, Fiscal year ends and reporting periods don't always align. Important tax information may arrive months after the corporation's year end, and accountants are often required to prepare financial statements and tax reporting before all of the information becomes available. To manage those challenges, we developed a structured approach. The first step is always to gather information. Good reporting starts with understanding what information is currently available. Investment statements, broker reports, T-slips, prior year records, and supporting documentation all provide valuable evidence. Once the available information has been collected, the next step is to analyze timing differences. This is where accountants determine which amounts belong to the fiscal year, which amounts may relate to other periods, and where reporting gaps may exist. After identifying those differences, professional judgment becomes important. If information is missing, reasonable estimates may be required. Those estimates should never be guesses. They should be supported by evidence, historical experience, and proper documentation. The next step is to track those estimates and differences. This is where tools such as reconciliation schedules, working papers, and clearing accounts become valuable. These tools allow accountants to monitor amounts that may need future adjustment. Eventually, the final information arrives. The T3 and T5 slips are received. The actual investment income details become available, and the accountant can compare the estimated amounts with the actual reported amounts. At that point, reconciliation takes place. Differences are identified. Adjustments are made if necessary, and the reporting process becomes more accurate. One of the most important ideas shown in the center of the slide is that this process is not a one-time event. It is a continuous cycle. Each reporting period provides new information. Each reconciliation improves understanding. Each year helps improve the estimates and reporting decisions used in future years. In that sense, good reporting becomes a process of continuous improvement. Notice the contrast shown on the left and right sides of the slide. Professional accountants avoid blind guessing. They avoid ignoring timing differences. They avoid waiting forever for perfect information. And they avoid poor documentation. Instead, they use the best available information. They document their assumptions. They reconcile when new information arrives. They apply consistent methodologies. And they exercise professional judgment throughout the process. The golden rule box captures the mindset that should guide every reporting decision. What information do I have? What information is missing? Is my estimate reasonable? And can I reconcile it later? If you consistently ask those 4 questions, you'll make better reporting decisions and produce stronger work. Finally, let's look at the summary at the bottom of the slide. The hybrid approach combines 4 important elements: accuracy, practicality, available information, and professional judgment. When those elements work together, the result is reporting that is reliable, defensible, and increasingly accurate over time. And that brings us to the most important lesson of this entire topic. The objective is not perfect reporting on day 1. The objective is reasonable reporting today and accurate reconciliation tomorrow. If you can gather the best information available, apply sound judgment, document your assumptions, and reconcile differences when better information arrives, you will have achieved the true goal of professional investment income reporting. And that is the framework that experienced tax and accounting professionals use every day when dealing with corporations that have non-calendar year ends.